Okay, I'm going to talk about provisions that are built into the Internal Revenue Code to help you reduce your estate tax. Okay, so this isn't some of the fancy estate planning techniques that lawyers talk about. I'll touch on them briefly at the end, but I'm talking about the ones that are provisions that are specifically built into the Internal Revenue Code, and that was my joke. Okay, this is adapted from one of the books that you got in your handouts. Estate Planning for Forest Land Owners, What Will Become of Your Timberland. Okay, but this talk is updated from what's in the book. It's been updated for the 1997 Taxpayer Relief Act and also for the 2001 Economic Growth and Tax Relief Reconciliation Act, or EGTRA. I want to point out that this is, or make the point that this is just an introduction to a complex area of law. Our intent is to familiarize you with some of the basic estate planning tools that are available to you. It won't make you a one-person estate planning team, so you'll still need other members on your estate planning team like Lloyd was talking about. Okay, and our focus is on tools of special interest to forest owners. If you have other types of assets, lots of other types of assets, there may be other options that are more suited to you. All right, so the first of the provisions that I wanted to talk about is gifts. And what this is the giving of money or property by one person to another during the donor's lifetime. So a gift is something that you do during your lifetime. So gifts of money or property are not taxable to the recipient ever, but they may be taxable to the donor. Gifts of income, though, or income from gifts of money or property are taxable to the recipient. So you want to be careful about giving income or the right to income, because that will be taxable to the recipient. Gifts with a value less than or equal to the annual exclusion, there's something called the annual exclusion, are not taxable to the donor and do not count toward the effective exemption amount for gifts. So the provision that talks about gifts is Section 2503 of the Internal Revenue Code. Before 1998, the exclusion was set at $10,000. It just stayed at $10,000 or $20,000 per year for married couples making what's called a split gift. And I never have figured out why it's called a split gift if you're joining two gifts together. But it was at $10,000 for a long time. The Taxpayer Relief Act, though, indexed the exclusion to the Consumer Price Index, tied it, to the Consumer Price Index beginning after 1998, with changes to be made in increments of an even $1,000. Due to inflation, low inflation, the exclusion remained $10,000 a year from 1999 through 2001, but now it's gone up to $11,000 starting in 2002, and it still is there. You and your spouse can make excludable gifts to as many different persons each year as you wish. So you could give me $11,000 and your spouse could give me $11,000. You and your spouse could each give Larry $11,000 and Lloyd $11,000 and Neil $11,000, or take a split gift if it was $22,000. Okay, so keep that in mind. Everybody in the room, you and your spouse could give $22,000 for each year. You can also make as many larger gifts as you wish, but they are going to count against the effective exemption amount for gifts that I bring up, talk about a little bit later. In addition, here's something a lot of people don't know about. There's an unlimited exclusion for qualifying gift payments of educational or medical costs. So this is provided in a different section of the code, 2503. The educational exclusion is only for tuition that's paid to a qualified educational organization, and you need to pay the organization directly. You need to pay the school or whatever it is directly. You don't pay the student and have them pay the school. You've got to pay the school directly. It's a similar thing for the medical exclusion. It's only for qualifying medical costs that are not reimbursed or reimbursable by insurance. So you can't pay an expense that insurance would have paid. And again, you need to pay the provider directly. You don't give it to the patient and have the patient pay the provider. So it needs to be a direct payment. And but it's unlimited if you're in a position to be able to do that for a relative or somebody that you'd like to do that for. Okay, the advantages of using gifts is, first of all, it permits you to transfer ownership of assets or cash. Cash is an asset, I guess, to persons of your choice during your lifetime. It also enables you to transfer and fix the value of, for gift tax purposes, of assets that are appreciating rapidly in value. So one thing you might consider gifting to people is interest in timber that's shifting out of pulpwood size into sawtimber size, because that's rapidly increasing in value, right? So that would fix its value in the pulpwood stage. Disadvantages is it may be awkward to divide some assets, for example, timber and timberland, into small enough pieces to not bump up against the limit, the $11,000 limit. Also, the recipient does not get a step up in basis, as Lloyd pointed out earlier. Their basis is the same as yours or less if the asset has lost value in your hands. Also, some gifts made within 3 years of death may be pulled back into your estate. That would be things like incomplete gifts that you keep strings tied onto them, and gifts of life insurance policies. Other types of gifts generally don't get pulled back in. All right, so that was gifts. Another provision that's built into the tax code itself called bequests. And what this is the giving of money or property by one person to another after the donor's death, either through a will, where you do it deliberately, or through intestacy, where your estate plan is your state's estate plan. So bequests of money or property are not taxable again to the recipient at the federal level, because the federal tax is an estate tax, not an inheritance tax. But they may be taxable to the decedent's estate if they're large. It may be taxable also to the recipient at the state level if your state has an inheritance tax instead of an estate tax. Again, bequests of income or income from bequests of money or property are taxable to the recipient. The recipient's basis in an inherited asset is its fair market value on the valuation date, and this is the provision that says that. So this usually results in what I said yesterday, a step up in basis. The recipient's basis is higher than yours, since most assets appreciate in value over time. So you can see if this is an asset that you acquired a long time ago, timbered land that you bought in the 50s or something, okay? It's appreciated a whole lot in value. Over time you die, your heir receives its value when they receive it. So they have a huge increase in basis. When they sell timber, if they sell timber pretty soon, remember with the depletion deduction, they're going to have almost zero taxable income from a timber sale. The valuation date is the decedent's date of death or the earlier of 6 months after the date of death or the date that any estate asset is sold. This is called the alternate valuation date. Now, the alternate valuation date may be used if it lowers the estate tax or the estate value, both, and the estate tax due. So you can only use the alternate valuation date if it does both these things. But if you use the alternate valuation date, you need to use it for all estate assets. You can't pick and choose, and you just apply it to some. Advantages of bequests: first of all, if it's done if it's done using a will, the ability to designate the recipients of specific assets. Okay, if it's done intestate, the state designates the recipients of those assets, so you don't get to designate them. Also, the step up in basis, which results in less taxable income to recipients if the assets are sold. The disadvantage is the inability to guide or train up the recipient in managing the asset. They just receive it all of a sudden when you die. Okay, another provision that's specifically in the tax code is called the marital deduction. And this is an unlimited deduction allowed for the value of all property that's passed from one spouse to the other, whether as lifetime gifts or as a bequest. So the advantages of the marital deduction is, first of all, it recognizes the role of both spouses in contributing to a family's assets, and it permits assets to pass untaxed to the surviving spouse. The disadvantage is it doesn't eliminate or reduce the estate tax, it just postpones it to the time of the second spouse's death. And this can be a big disadvantage if the assets appreciate greatly in value in the time between the two deaths. Okay, the next provision is called the effective exemption amount or amounts. This is kind of a two-step thing. From 1971 through 2001, so for 30 years, the federal estate and gift taxes were combined into a single unified tax on the value of a decedent's estate, plus the value of any lifetime gifts that they made above the annual exclusion. The unified credit, a credit against the tentative estate tax due, effectively exempted a portion of the combined values of gifts and bequests from the federal estate tax. The effective exemption shielded all of smaller estates and a portion of larger estates from the federal tax. Prior to 1998, the unified credit effective exemption amount was $600,000, so that was the amount that was shielded. The Taxpayer Relief Act scheduled a series of increases in the unified credit effective exemption amount up to, it was going to reach $1 million by the year 2006, so it was a kind of a slow process schedule. EGTRA, though, short-circuited this schedule. It split the gift taxes and the estate taxes apart into two separate things now, and it set separate effective exemption amounts for each. The effective exemption amounts for gifts was set at $1 million beginning in 2002. There's no provision to increase or adjust the gift tax exemption for inflation, so it's just holding steady at $1 million. So since the cumulative value of gifts above the annual exclusion that a taxpayer makes reaches, or once, that value reaches $1 million, he or she will owe federal gift tax on any additional gifts above the annual exclusion that they make year by year. The effective exemption amount for estates now, not gifts, but estates, was also set at $1 million for 2002 and 2003, but it increased to $1.5 million beginning in 2004, and is scheduled to increase to $2 million beginning in 2006 and $3.5 million in 2009. After 2009, for a year, it's infinite, right? And then it goes back to the schedule that was going up to $1 million. As well, EGTRA reduced the top rate for the federal estate and gift taxes down to 50%. If you look at this schedule, the top rate in the schedule is over 50%. In the book, but it went down to 50% right away after EGTRA was passed in 2002, and it's continuing to go down 1% a year until it's going to reach 45% in 2007. So the top rate now in 2005 is 47%. Beginning in 2010, EGTRA eliminates the federal estate tax entirely and sets the top tax rate for gifts, so there still will be a tax on gifts equal to the top individual income tax rate. But EGTRA itself is scheduled to sunset at the end of 2010, and the law snaps back to what it was before EGTRA, okay? So advantages of the effective exemption amount is it permits at least some of a family's estate to pass on tax from one generation to the next or another. The total amount shielded from the federal income tax effectively doubled in 2002. Since it was $1 million, it went from $1 million, or headed towards $1 million, to $1 million for gifts and $1 million for bequests, and is scheduled to continue increasing through 2009. So this reduces the pressure to fragment holdings or liquidate timber, worries that Lloyd talked about, in order to pay your federal taxes. The disadvantage is that families, it's not a real disadvantage, it's an error in strategy. Families headed by married taxpayers have the opportunity to use this effective exemption amount at the death of each spouse. All right, and often they don't. They only use it on the death of the second spouse to die due to inadequate planning. Special use valuation. Lloyd also started off a talk on this. Okay, under certain conditions, an executor can elect to reduce the value of an estate for federal estate tax purposes by valuing estate assets used for farming or in a trade or business. And this is where timber production falls in, not the farming part, but the trade or business part, according to their value in actual use rather than their highest and best use. So this is the Internal Revenue Code section that talks about that. Before 1998, the amount by which special use valuation could reduce the taxable value of an estate was set at $750,000 for many years. The Taxpayer Relief Act indexed the amount to the Consumer Price Index beginning after 1998, with changes made in increments of $1,000. So this is what Lloyd asked about. For 1999, it went up to $760,000, and you can see it's gradually increased year by year. For 2004, it was $850,000, and for 2005, it's $870,000. The advantages of special use valuation is, first of all, it reduces the federal estate tax due. It also reduces pressure to fragment holdings or liquidate timber, and it helps ensure the passing of a family enterprise intact from one generation to another. Disadvantages is there are stringent requirements that I'm going to go through. To qualify for and remain under this provision, including the inability to harvest any timber that you apply special use valuation to for 10 years. Also, separate elections on separate forms are required for land and timber if you need to do both. All right, you elect to use special use valuation at all by checking a yes box on Form 706. To special use value timber, you make what's called a woodlands election on Schedule A1 Part 2. Okay, so separate elections. Here's the requirements. To be valid, the decedent must have been a U.S. citizen or resident, and the property must be located in the U.S., not Australia. The property must be transferred to a qualified heir. So this is going to be linear descendants or precedents, an ancestor, spouse, or lineal descendant of the decedent, or of the decedent's parent, spouse, or lineal decedent. Okay, got that? The property must have been owned by the decedent and or a member of his or her family for at least 5 of the last 8 years before the decedent's death. The property must have been used for farming or a closely held business, and again, this is where timber comes in, and must have been devoted to that use at the time of the decedent's death. The decedent or a member of his or her family must have held an equity interest and materially participated. This is what Larry talked about yesterday. In the operation of the property at the time of the decedent's death and for at least 5 of the last 8 years before the death. The 8 years before the decedent became disabled or began receiving Social Security benefits may be substituted for the 8 years before death, as long as to a qualified heir. A non-qualified property cannot have been gifted to the decedent within 3 years of his or her death in order to meet those two tests, the 50% or 25% test that's drawn back into his estate, the decedent's estate, for the purposes of these tests. All heirs with an interest in the qualifying property must sign an agreement, okay? You have to have all the heirs agree to this, to use special use valuation, and that must be filed with the estate tax return. For 10 years following the decedent's death, or 12 years if the full allowable 2-year grace period is used, first of all, the decedent's family or qualified heir must retain full ownership of the property, except in the event of an involuntary conversion or like-kind exchange. At least one heir must materially participate in management of the property in at least 5 of every 8 years, and the qualified heir must retain an equity interest in the property, and it must be managed and used for that qualified use. Okay? The estate tax saved is subject to recapture if, first of all, the qualified use is discontinued within 10 years of the decedent's death. That's why we can't harvest timber. Any special use valued asset is sold. No, this is it. Within 10 years of the decedent's death. This includes the selling of special use valuation timber, whether or not it is sold in accordance with an existing management plan. Okay? So it's just a freeze on timber sales altogether. Okay, AGTRA specified that the net cash lease of a special use valued property, this is a provision mostly for farmers, by a lineal descendant of the decedent does not invalidate special use valuation. That's a special provision that was specified in there for farmers who lease their land. Okay, so that was simple. This is mud, by the way, not anything else. Okay, the next thing to talk about is the exclusion for interest in a family-owned business. For estates of decedents dying after 1997, if 50% or more of the decedent's estate consisted of interest in a qualified family-owned business, so this would include a timber production business, the executor could elect to exclude up to $1.3 million of the interest from the value of the estate for estate tax purposes. The excludable amount decreased with increases in the effective exemption amount, so that the amount of the estate value that was shielded from federal estate tax remained constant at $1.3 million. So what's the effective exemption amount now? It's $1.5 million, so it's up above this number, right? So what happened is AGTRA repealed this provision in 2004 when the effective exemption amount for estates increased to $1.5 million. So this is in here for historical purposes, I guess. The next thing is exclusion of land subject to a qualified conservation easement, and again Lloyd touched on this. For estates of decedents dying after 1997, the executor may elect to exclude from the value of the estate for federal estate tax purposes up to 40% of the value of land subject to a qualified conservation easement. This is another provision added by the Taxpayer Relief Act. The amount of the exclusion was capped at $100,000 for 1998, and it went up gradually and now it's at $500,000 for 2002 for later years and later years. The advantages of doing this is, first of all, obviously it reduces the estate tax due. It also reduces the pressure to fragment holdings or liquidate timber, and helps ensure the passing of a family enterprise intact from one generation to another. The disadvantage is that the basis in excluded land is not stepped up but remains the same as it was in the decedent's hands. There's some requirements. To be valid, the Taxpayer Relief Act required that land subject to the conservation easement be located within 25 miles of, that should be of, a metropolitan area, national park, or wilderness area, or within 10 miles of an urban national forest. Now, what was an urban national forest was never defined. EGTRA, though, eliminated this requirement, so any land subject to a conservation easement qualifies regardless of where it's located. All right, another provision is called disclaimer, and what this is an unqualified and irrevocable refusal by a recipient to accept a donor's gift or by a beneficiary to accept property during probate. And this is the Internal Revenue Code section that talks about disclaimer. Advantage of a disclaimer is lets the transferee, for example, the surviving spouse, permit property that he or she does not need to pass on to others, for example, children, without the property entering their estate. The disadvantage is, of course, the transferee loses all control over and benefit from that disclaimed property. To be valid, there's some requirements. The refusal must be in writing. The refusal must be received by the transferor or his or her representative, obviously the executor, within 9 months after the date of transfer or the date that the transferee becomes 21 years of age. For transfers at death, the 9-month period, the clock starts ticking at the date of death, not the date of probate. The transferee must not have accepted the property or any of its benefits. Merely taking delivery of title does not indicate acceptance, but doing any of these following things does indicate acceptance: using the property or an interest in it, accepting dividends, accepting interest, accepting rents, directing others to act with respect to the property or an interest in the property, or directing who the property is to go to other than him or herself. So if you disclaim a bequest, you can't even say who it goes to. Note, a disclaimer of property held in joint tenancy with the right of survivorship. This is a thing that, like for married couples, must be made within 9 months of entering that joint tenancy. For what this says is, in this case, disclaimer is not available for long married couples unless long marriage is less than 9 months. Okay, deferral and extension of the estate tax. If interest in a closely held business accounts for more than 35% of a decedent's estate, the estate tax on the business portion of the estate can be deferred for 4 years after the estate tax return is filed, with only interest payments due, and then paid in up to 10 annual installments. So it spreads it out over 14 years. No deductions allowed for the interest payments, either as an estate administration expense or as an income tax deduction. What this does is eliminates the need to file supplemental estate tax returns every year. TRA and EGTRA did not directly change the deferral and extension provisions for the federal estate tax. Taxpayer Relief Act, though, reduced the interest rate on the deferred estate tax to 2% for the first $1 million of taxable value in the business, and 45% of the rate applied to tax underpayments for any additional amount. So it really cut the interest rate way down. And EGTRA increased the maximum number of partners or stockholders to qualify for a closely held business from 15 up to 45. EGTRA also made the extension provision available to closely held lending and financing businesses, but for 5 years rather than 10. The advantages of deferral and extension is, first of all, it reduces the pressure to fragment holdings or liquidate timber and helps ensure the passing of a family enterprise intact from one generation to another. It also reduces the need to disrupt an established forest management plan in order to pay the federal estate tax. The interest imposed on deferred payments is sharply reduced compared to 4% or more as under the previous law. There really aren't any disadvantages, but when the House and Senate were considering the Taxpayer Relief Act, that they would have permitted payments to be extended over 20 years instead of 10. So we didn't get that additional benefit. There's some other tools that estate planning professionals have developed over the years. They're not specifically provided in the Internal Revenue Code. There's no sections that specifically discuss them or describe them. But what they do is facilitate intergenerational transfers of family assets. A detailed discussion of those provisions or those strategies actually is beyond the scope of this workshop, but a brief sampling is I can use that to illustrate the variety of tools that are available. Okay, one strategy is forms of business organization. Okay, so this addresses an earlier question. There's two forms of organization that are becoming popular as means to transfer ownership of forest land and create interest in its continued management. And so one of these is called a Family Limited Partnership, or FLP, and another one is called a Limited Liability Company, or LLC. Let's talk about Family Limited Partnership first. What it is a type of limited partnership which is a pass-through entity for income tax purposes. The general partners, for example, the parents in the FLP, retain management rights but can transfer ownership to the limited partners through gifts, which can be discounted for minority interest and or lack of marketability. So the parents can create a family limited partnership and transfer ownership, increasingly large chunks of ownership to the children, $22,000 each a year, right? And you can actually pass more if you make a discount for minority interest or lack of marketability. So it can be not only $22,000, but 25 or 35% more than $22,000. The limited partners, for example, the children are not personally liable for partnership debts. Their total liability is limited to their investment in the partnership. So they have limited liability. There's no step up in basis, though, for forest land or timber that's transferred to limited partners by means of an FLP, so their basis is the same as the parent's basis. A limited liability company is a hybrid between a corporation and a partnership. So this is the other entity. Like a corporation, members' liability is limited to their investments, so they have limited liability. Like a partnership, an LLC is a pass-through entity for income tax purposes, so there's no double taxation. Unlike a corporation, state law usually permits an LLC to customize allocation of profits and losses to its members, so it can spin the losses to some members and the profits to other members. Also, unlike a corporation, neither the LLC nor the member recognizes gain or loss if the LLC distributes appreciated property to the member. Unlike a partnership, an LLC member can materially participate in the management so that income and losses passed through to him or her are active rather than passive, with all the benefits that Larry was talking about, without risking unlimited liability as a general partner. Okay? That's a big thing if you read it enough times. Again, there's no step up in the basis of forest land or timber that's transferred to members by means of an LLC. You need to be aware, though, that the IRS is attacking FLPs and LLCs under Section 2036A of the Internal Revenue Code as tax avoidance devices that lack economic substance. So they're attacking their economic substance of some really flawed examples. So there's, some of the more famous cases are Harper, Strange, Kimball, and Thompson in recent years. So the lessons we learned from those is, first of all, lesson number one, the FLP or LLC must be able to show substantial business and other non-tax reasons for even existing, okay? What this means, the practical applications of that is that the assets should be monitored and actively managed. The management should be consistent with the purposes that were set forth when the organization was established. You need to file all required tax returns. And it's better for the FLP or LLC to manage operating business assets, for example, forest land, rather than passive assets, for example, stock. Second lesson learned, the partners or members should give actual consideration in return for their interest in the FLP or LLC. Non-cash assets should be retitled to the FLP or LLC with all the I's dotted and all the T's crossed. Each member or partner's share of the overall interest, their earnings, and their tax implications ought to be proportional to the amount of consideration that they give. I mean, that would be the cleanest way to do it, although it's possible to tailor. The FLP or LLC must be maintained as a separate entity. Okay, that was the flaw with a lot of those, is the parents set it up and then just commingled assets. The partners or members should retain their assets outside the FLP or LLC that are sufficient for their support over their expected lifetime, so they don't have to commingle assets or live off of the FLP's or LLC's assets. And there can be no commingling of personal and business assets. Okay, another strategy is trusts, and again Lloyd introduced this idea. What this is an arrangement by a person or by which a person or entity called the trustee holds legal title to the designated property in trust and manages it for the benefit of the beneficiaries. So a trust is a separate legal entity under both federal law and state law. The rules governing administration of the trust come from federal law, state law, and the provisions that are written into the trust instrument itself. You can create a trust during your lifetime or upon your death. A lifetime trust is created during your lifetime and can be revocable or irrevocable. The major use of a revocable trust is to try out provisions so you can tailor them to your specific situation. Because you can change or terminate a revocable trust at any time, there are no tax savings, although the trust property is not subject to probate. It passes without probate. Under an irrevocable trust, you permanently relinquish control of the trust property, which is why irrevocable trusts aren't that popular, I guess. There may be gift tax implications, but the trust property is permanently removed from your estate. A testamentary trust is created at your death according to instructions in your will. Generally, you'd use a testamentary trust if you're unwilling to give up control of the trust property during your lifetime. Again, the control issue. The cost of retaining that control, though, is that the full fair market value of the trust property winds up being included in your estate. So you can't use testamentary trust to get property out of your estate. It has to be a inter vivos trust, a lifetime trust. The advantage of a testamentary trust is that it can protect trust property from successive estate tax levies for your heirs and their heirs and their heirs, while the income is utilized by successive generations of beneficiaries. So just to give an example of the types of things that trusts can do, here's 3 different types of trusts. An irrevocable life insurance trust, or an ILIT, what that does is it removes a life insurance policy from your ownership without giving control of it to a beneficiary. And if you don't want to have the life insurance included in your estate, it needs to not be owned by you. It needs to be owned by somebody else. Another type of trust is called a Q-tip, qualified terminal interest property. What this does is it provides the surviving spouse a life income while controlling disposition of the trust property remaining after his or her death. So this is a popular thing with blended families. That's what I just said. A pourover trust that I think our attorney today is going to talk about. What it does is receives and accumulates payments from various sources as they occur over time. Following the decedent's death, it can be designed to give the surviving spouse a life interest in the proceeds, with any remaining assets passing to others, for example, your children, without entering your spouse's estate. There are many more other types of trusts and other tools available for use in estate planning, including, here's some other names of trusts. You've got crummies, grits, grats, and gruts, GSTs, conservation easements, retained life estate that we talked about earlier today, and your estate planning team can help you understand and apply those. Okay, so that was easy.